This is the quiet crawl back from the doldrums of the last few years for bonds, highlighted in the weekend version of the journal about the big comeback for fixed income for bonds.
Yeah, like the professional version of the journal, right? Another
Yeah.
article you sent me from the Wall Street Journal. This one maybe a little more responsibly written. It's kind of funny. We're going from like the most speculative, volatile asset class that you can think of to bonds, which is like the piece of the portfolio that typically isn't going to take on a whole lot of risk. But it's a great point that you bring up. Part of the pain that came from bond investing back in 2022, we're getting a payoff on it now because we have higher yields. The Federal Reserve has been cutting rates. And so you're getting both decent yields out of fixed income right now, plus a little bit of price appreciation. So yeah, what are like I think I was seeing like intermediate term treasuries are up something like 7% year to date. When you factor in
Yeah.
price appreciation and yield, that's pretty good for fixed income.
Bonds can be the wild, wild west in terms of credit quality, maturity, and all the other factors that go into a bond investment. But generally speaking, your garden variety diversified portfolio of bonds that are of, you know, investment grade credit quality or better, or hitting low, mid single digit returns so far through October of 2025 and in November. So that would be if you would ask someone, what's your long term expected rate of return for bonds, that would probably be somewhere in that ballpark. So after coming off of a 15-ish% calendar year decline in 2022 with some pressure beyond that into 2023, you're seeing bonds finally behave